So headline risks. We're well aware of the news cycle. More bad news than good news, it seems like lately. And the market's really reacting to that. So I want to take a look at what some of the headline risks are. Are they real, or is the market maybe overreacting to some of them? Headlines create fear. Fear creates volatility. And so as I was coming up with slides for this portion of the presentation, I came across this quote that I thought was very timely given the current environment in the markets. The key to successful investing is not predicting the future, although it would be nice, but we don't have a crystal ball. So the key to successful investing is not predicting the future, but looking at the present with clarity. So what I want to do is take a look at some of the major headlines, some of the major news items that we've seen so far in 2016, and take a closer look and try to get that vision and that clarity with it. So the three headlines, as I'm sure you've been well aware of, is China, oil, and the Federal Reserve. And each in their own ways, you know, when I wake up in the morning, if I see a negative headline on oil, I look to the right, I'm expecting to see the markets in red. And vice versa, if oil's up, you know, usually we'll see green in the overall market. So, you know, how are these headlines affecting the markets, and what's really taking place? So China, you know, we have the headlines. There's so many you could find that are mostly negative. On one side, we have the American economic recovery. The other side, the Chinese slowdown. How is this going to affect world markets? So let's just go through some examples here. Name this country. Large manufacturing economy, located in Asia, quick rise to the second largest economy in the world, bursting real estate market, high private sector debt, produce 14% of global output. Sounds just like China. It's actually Japan in 1990. Very similar circumstances as China today. Japan found itself in 1990, just before that lost decade. So we're going to take a look at a comparison of some factors between Japan in 1990 and China at the end of 2014. This first two bars, so blue is Japan, pink is China. World imports. China makes up a little bit more of world imports than Japan did back in 1990, which makes sense given their investment and their growth and their infrastructure. I mean, that's why commodities and other emerging market economies are being hurt so hard right now because of the slowdown in China. They were importing a lot of commodities to support that growth. The middle graph, or middle bar, I think is even, you know, clearer picture, the world GDP. And in 1990, Japan actually made up more of the world GDP than China did last year. And last but not least, Asia Pacific GDP. As you can see, again, Japan far out exceeded China last year in what the Asia Pacific GDP was, so, or their portion of Asia Pacific GDP. So Japan had a pretty big impact, you know, going back 25 years ago. Now I want to show you just a chart of the S&P since 1990. Pretty similar circumstances. There was some volatility during that year, but overall, you know, being invested in just the S&P, you can see how great the returns were after that point. So obviously, again, we don't have a crystal ball. We don't know what the markets are going to do from here, but we've seen similar circumstances in the past, and so it's good to keep that in mind when we're seeing the slowdown in China now and how it may affect the U.S. economy and the U.S. markets. So let's view the present with clarity. U.S. economy, we're saying, is not dependent on China. Less than 1% of our GDP is made up of exports to China. China has been slowing for years. I think their GDP peaked in 2007. Ever since, it's been coming down. They're experiencing a great migration from west to east. They've been a large agrarian society and economy, a lot of investment in their infrastructure. Now a lot of those folks are actually moving to the cities and being more of an urban atmosphere and a consumer-based and consumer-driven economy. So we're expecting to see slowdown, but it doesn't necessarily mean that, you know, their economy is tanking, and it really shouldn't affect ours overall. Volatile Chinese stock market. Chinese stock market in the past has always been more volatile than U.S. stock market. It's closed to outside investors. It's made up of mostly private investors, not large institutional investors. So you see many more swings and dips in the Chinese market than you do in the U.S. market. And a lot of times their performance is not indicative on how their economy is doing. And last but not least, as we discussed, we've seen a similar scenario before back in Japan. So the second headline, oil. Oil, I think more than the beginning of the year, China, a lot of headlines that really drove the market. Recently, it's been all about oil. So in the cartoon here, we have the Saudis and OPEC trying to keep producing, keep prices down to drive out some of the U.S. exploration and mining that's really overtaken the world economy in the last couple of years. Oil, how much does the energy sector really affect our overall economy? You'll see the top line is mining, oil equipment, and structure investment as a percentage of overall business investment. So you see that's overall business investment, it makes up about 12%. But when you look at that investment as a percentage of overall GDP, it's closer to 1%. And the overall effect that the energy sector has on US GDP is only around 3%. So while slowdown or lower oil prices is going to hurt our economy, it's not necessarily going to take down our economy. Here you see the drivers of what our economy is. 68.4% of our GDP is made up of consumption. So the consumer makes up a far greater percentage of overall GDP compared to that gray chart. Second from the top is investment, which we were talking about in the last chart, 13.4%. So much smaller percentage of overall GDP. In lower oil prices, again, I'm sure you're seeing it at the pump, is helping the consumer. So it's maybe hasn't matched up quite yet, but this benefit to the consumer should help GDP overall going forward. This is just a chart. The blue line is supply. The black line is world consumption. You see, we kind of had that breaking point heading into 2014, and that's when the price of oil peaked over $100 per barrel. Right now, it's floating around 30, and as we go forward in the projections, we are seeing production fall a little bit, and hopefully we'll continue to see consumption rise. This is a great indicator. It may be hard to see, but the top portion is production. The lower half of the chart is consumption. And you see in 2013, production was less than global consumption. So that was driving the price of oil up. 2014, you saw the big change, and what really drove that was fracking and shale and the boom to the US oil industry. That went from 12.4 million barrels a day to 14.1 million barrels per day, which is a pretty big increase. And that's what really drove that difference from production being less than consumption to production being greater than consumption. And ever since that, 2014, 2015, and probably into 2016, we're going to continue to see that. But we're also starting to see a little bit of a slowdown in production, especially in the US. OPEC, on the other hand, has kept production up. They'd rather keep their market share rather than lose out to the US oil manufacturer or producer. So that's kind of why you're seeing such a drop in oil prices right now. So again, viewing the present with clarity, last decade, there's really no correlation between the stock market and oil. This has been something that's been going on towards the end of last year, and so far the first 6 weeks or so of this year, we're seeing a strong correlation between oil and the stocks, but that may not continue to go on, especially when we see oil hopefully stabilize in the near future. The energy industry is not the financial industry from 2008. Marty's going to get a little bit more into kind of what we're seeing in the US economy, but we don't feel that the drop in oil and the hit that the energy sector is taking is going to lead us into another recession. Low-cost oil is a boost to consumers. And finally, we talked about it's really been a supply side issue so far. And last but not least, the Federal Reserve. We're seeing today, especially what's Janet Yellen saying. It's almost, we'd almost prefer them to stop talking and get out of their own way to just see how these markets and how the economy plays out. Here we have the central bankers gone wild. So on the left, we have the Bank of Japan. How low can you go, Mario? Mario Draghi in the middle, European Central Bank. Hey, look what I can do. Now they're under 0%, so they're in negative interest rate territory. And last but not least, Janet Yellen. I really should be leaving, and we hope she does from this party. So this chart is a little harder to read, but hopefully I'll kind of explain what it means. So the x-axis here is a 10-year Treasury yield. The y-axis is a correlation coefficient. So how is rising interest rates, how do they match up with stock prices? So as you can see, the orange chart, or the orange bar going down the middle is at right around 5%. So right now, 10-year Treasuries at right around 1.8%. In this range, as interest rates rise, stocks in the past have historically been positively correlated. So if we see a rise in interest rates based on historical figures, we've seen a rise in stock prices. It isn't really until we hit that 5% interest rate, which would lead us into a much different economic cycle than we are right now, where we see that positive correlation become negatively correlated, and those higher interest rates may hurt stock prices. And last but not least, we have previous, going back 35 years or so, Federal Reserve interest rate hikes. And you can see the pace of the hikes going back is much faster than what the proposed hikes are this time around, which I don't think will hit. But you can see 7 hikes in 14 months, 10 in 11 months, 7 hikes in 12, 6 hikes in 11 months, and last 17 hikes in 24 months. Now, the Fed has said they want to raise them 4 times in 12 months. I don't think that's going to happen, but it's good to remember that we've seen hikes in the past, and if we do, even if we were to reach 4 hikes in 1 year, it's much slower than anything we've seen going back the last 35, 40 years. So let's view this with clarity again. A rate hike at these levels is not the end of the world. Rising interest rates have historically been correlated with the stock market at this level, and proposed rate hike schedule is very gradual, and future moves are data dependent. We may not see those 4 moves in this coming year, but we'll continue to see how the economy evolves.